Good morning, class, and welcome to the Chapter 6 and 7 Instructor Review. The first topic we'll talk about this morning is the purpose of a bank reconciliation. The balance of a checking account reported by the bank statement rarely agrees with the balance in the depositor's accounting records. Rarely. So another way to say this is the cash balance per the bank and the cash balance per the books, which would be on your computer, rarely agree. And here are some reasons for the differences. The bank, for example, might not know about deposits in transit, which you have to add. And also, they may not know about some outstanding checks that you'll have to subtract from the bank balance. And then also there could be some banking errors. Anyway, we're all trying to get to this, which is the adjusted cash balance. Now, like I said, the bank doesn't know about these things, and also there's things that the books don't know about because you haven't received a statement yet. And examples would be sometimes the bank collects money for a large customer, and those collections with interest would be something that the books wouldn't know about until you received some type of statement. Also, you want to subtract any bank fees or NSF checks, that is funds, non-sufficient fund checks, from the book balance, but you won't know about them until the bank lets you know about them. Anyway, and also there could be some errors that you put down in the books. You might record something incorrectly, and you might have to add or subtract from that. Anyway, the idea is when you do bank reconciliation, and there's lots of software packages that do this, you're trying to make sure that both sides have the same adjusted cash balance. So let's look at our first example here. Oh, and also, we won't get into this, but there are adjusting entries in the real world that the books have to make to sometimes reconcile and make sure that the books and the bank agree. But like I said, we're not going to cover that in this review. So here's our first little problem here. It's exercise 6-12, I believe. Delgato's clinic cash account shows an $11,589 debit balance in its bank statement. So the first thing we'll do is we'll show the bank statement is $10,555, and we'll put this on a, by the way, a bank reconciliation goes on a separate piece of paper, or now in the real world, it doesn't go on a piece of paper, it goes on some type of spreadsheet, or a lot of times the accounting software has all this built into it. But anyway, it's also, it looks just like this. You're going to have one side for the bank and one side for the books. And when all the smoke clears, you're going to make sure that both sides on the bottom here reconcile with each other. That is, they agree. So we start off with the bank statement, $10,555. We have outstanding checks as of June 30th totaling $1,829. Now, the first thing you have to ask is, who doesn't know about this situation? Is it the bank or is it the books? And if that's, when you figure out which side doesn't know about it, then do you have to add or subtract? Well, for outstanding checks, you're going to put something, let me go over here and put in here the according to the cash for the books. I forgot to add that. So the book balance is $11,589. The bank balance statement says $10,555. Now each of these separate transactions, we'll have to decide who doesn't know about the situation and add or subtract it. So outstanding checks are something that you want to, let me get these formats down here. Outstanding checks are something that the bank doesn't know about, right? Because they haven't cleared the bank. And so therefore, they're going to be subtracted from the bank side. And then we have a June 30th bank statement includes a $16 debit memo for bank services. So we've incurred some bank fees, but we don't know about them until the bank statement arrives. And so that's something the books doesn't know about. And we will subtract from the book side this $16 charge. And then we've got Check number 919 listed with the canceled checks was correctly drawn for $467 in payment of a utility bill on June the 15th, and Del Gato's clinic mistakenly recorded with a debit to utilities and a credit to cash for $476. So forget about the debit and credit part. The bank correctly recorded this at $467. We put it on our books at $476. So that's a $9 difference there. That's called a transposition error. That is when you have a $9 difference in any situation, you've got what's called a transposition error. Now that $9, we took out too much cash. So when we get this information back from the bank, we're going to have to adjust the book side, and we'll adjust it up by that $9. Now let's go on to the next one. June 30th, cash receipts of $28.56 were placed in the bank's night depository after banking hours and were not recorded in the June 30th bank statement. All right, well, this $28.56 is something the books already knows about. In other words, it's already reflected in this balance. Therefore, the bank doesn't know about this. It's called a deposit in transit, and we must add it to the bank side because, like I said, the books already know about it. So this deposit in transit will be $28.56. It looks like we've looked at all the items here, and now let's see if when we add and subtract things on the side that the bank didn't know about and add and subtract things that the books didn't know about, let's see if we get a reconciled account balance. So we go through here and we're going to come up with, looks like an adjusted balance on the bank side of $11,582. We'll add the 9, subtract off the 16 to come up with an adjusted balance on the book side of, looks like, $11,582. So we're in balance and we can go on now. And so that's how you reconcile a bank account using this information about what is it that each side doesn't know about and either add or deduct it. Let's go a little further. Next thing we're going to do is compute the days sales uncollected ratio and use it to assess liquidity. Here's days sales uncollected. It indicates how much time is likely to pass before we receive cash receipts from credit sales. And the way you do this calculation is you take accounts receivable and you divide it by net sales and you multiply that by 365 days. So here we have two companies. We have Starbucks and we have Jack in the Box. So, looks like we had a little problem there. So looks like days sales uncollected for Starbucks going from 2 years ago to the current year is 13.7, 13.2, and 14.2. So it looks like days sales uncollected are going up for Starbucks. Let's take a look at Jack in the Box. Starts at 11.4, 16.7, and 16.2. So it looks like overall it's gone up a little bit. Now let's, and by the way, days sales uncollected, higher is worse, okay? Your receivables are, let's say, have less quality if it takes you a lot longer to collect them. At GE, I don't expect you to remember this, but at GE we used to say, what are your terms of sale? If they're 30 days, then you want to add 15 days to that, whatever that term of sale is, and that's what your ideal days sales uncollected should be. But I won't get into that. I'll just say that it looks like Jack in the Box is getting a little worse, and so is Starbucks. So here's our problem that we're going to have. The following annual account balances are for Armor Sports at December 31st. We have year 2 and year 1, and they give us accounts receivable and net sales. And they want you to complete the table below to calculate the number of days sales uncollected for year 1 and year 2. Round your collections to the nearest one place. So in this little table, we've got a numerator, which would be the top of the fraction, a denominator, which would be the bottom of the fraction, and then there's days right there, which would be 365, I suppose. And then you'll get your answer, days sales uncollected. So let's see what we got for each of these. So accounts receivable divided by net sales, times 365 days will equal our days sales uncollected. That's our little formula we got from the previous slide. Now let's look at year 2. To calculate this for year 2 for Armor Sports, we're going to have $25,180, which is accounts receivable for year 2. That's the ending accounts receivable. And how do I know it's ending? Because all this information is at December 31st, right? So divided by net sales, which would be 256,836 times 365. Our days sales uncollected would be 35.8 days. Let's take a look at year 1. Year 1, 12,214 divided by 112,314. All that is then multiplied by 365 to get 39 days. So it looks to me like going from year 1 to year 2, things have gotten a little better, from 39 days sales uncollected to 35.8. All right, let's see what else we got. So is the company's collection of receivables improving? Yes or no? The answer should be yes. Let's take a look at another one here. We've got days sales uncollected for 2 real live companies, Apple and Google. And here's their information. And we know their formula, right? Accounts receivable divided by net sales, all of that times 365. They gave us all the information for the prior and current year for Apple and Google. And the first thing we'll do is compute days sales uncollected for Apple and for Google for current and prior years, and then answer the question, which company had more success collecting receivables? Well, we know the formula, we know how to do it, so let's just go through and find out what the answer is here. For Apple, for example, prior year was 26.7 days, and current year is 28.5 days. It looks like Apple's collection is getting a little worse. Let's look at Google. Google's 60 days and 57 days last year, so it looks like Google's collection time is getting a little worse, and so both of them looks like are not improving. They're getting a little bit worse. So which company is more successful? By far Apple, because 28 days beats 60 days every day of the week, right? Okay, let's look at another one. Accounts receivable turnover. Looks like we have 2 companies here, Visa and MasterCard, and their accounts receivable turnover is basically how many times can you turn these receivables over, and higher is always better because you're turning them into cash, right? Just like inventory turnover is better the higher it is. So 2 years ago for Visa it was 16.9, then it went to 17.6, and then 16.7. So it's probably just pretty much staying the same to me it looks like. Then MasterCard, 7.4, 7.0, and 7.0. So it looks like MasterCard's a little bit better in terms of receivables turnover. But who has the highest turnover overall? It looks like it's Visa, right? Visa's doing a much better job. They're turning their receivables over twice as fast as MasterCard. And that's very important. Okay, now let's look at a problem. We've got information from a year ago and current year, and we're going to compute Rocky's accounts receivable turnover. And of course, we know the formula is net sales divided by average accounts receivable, and that will be then give us our turnover. Now, average receivables means at the end of last year, that's really the same thing as the beginning of this year. We're going to add that to this year, ending year, add them together, divide by 2, and then divided by the current year. So we're going to find this for 1 year, and it looks like we're going to have 1,041,105 for sales, and then our accounts receivable average will be, like I said, 157 plus 142, add them together, divide by 2. You should come up with 149,550. That'll be divided into net sales to give you a turnover of 7 times. Now, we don't know if 7 times is good or bad. We have to compare it to previous years and also to other companies in the same industry. So let's see. Here we go. Part B. If its competitor Dixon had an accounts receivable turnover of 9. Which company appears to be doing a better job of managing its receivables? Well, 7 is not as high as 9, so it looks like Dixon's doing a better job. All right. Let's look at another situation here from Chapter 7. Let's see, the following information is from the annual financial statements of Rahim Company. We've got year 1, year 2, year 3, and we're given net sales and accounts receivable at the end of the year. They want you to compute the accounts receivable turnover for years 2 and 3. Keep in mind, again, that we want the average accounts receivable, and so let's just go through it here and do it. So net sales in year 2, if you're computing year 2's accounts receivable turnover, year 2's would be the receivable at the end of the year for 1 and 2 added together divided by 2. For year 3, it would be 2 and 3 added together divided by 2. So we've got 16,850, and that gives us a receivables turnover of 13.2. For year 3, we've got the sales and the average accounts receivable, and it looks like our receivables turnover in this case would be 14.8. So in year 2, it was 13.2, and if this is going forward, I'm not sure what it is. It is going forward. It looks like our receivables turnover has gotten a little bit better, 14.8 compared to 13.2. So assuming its competitor, that's Rahim's competitor, has a turnover of 22.3, is Rahim performing better or worse at collecting its receivables? Well, it's performing worse because 13 and 14 times is slower than 22. So that's it for anything you need to know as far as the review for Chapter 6 and 7. And good luck on everything you're doing in this class, especially this upcoming exam. And that's all for now.